The Weaponization of Debt, How the Banking Industry Extracts Wealth from the Global Economy. Summary statement. This exposition examines how the banking industry has transformed debt into a weaponized product, perpetuating wealth transfer from global productivity to financial institutions. By creating tailored debt products for every economic actor, ranging from credit cards to sovereign loans, banks establish a cycle of dependency and servitude. The system is sustained by geographic fragmentation and correspondent banking, which impose hidden costs on cross-border transactions, further enriching financial institutions at the expense of global trade and commerce. Through this analysis, we uncover the mechanisms behind this economic framework and explore its far-reaching implications. 1. Introduction. The modern financial system is built on the foundation of fractional reserve banking, a mechanism that allows banks to lend far more money than they hold in reserves. While this system has fueled economic growth and innovation, it has also created a structural dependency on debt, transforming it into a product that drives wealth transfer from global productivity to financial institutions. This exposition explores the systemic consequences of debt as a weaponized product, its impact on economic actors, and the fragile interconnectedness it fosters. By dissecting the mechanisms behind debt's proliferation and highlighting alternatives, we aim to offer a clearer picture of the financial landscape and its potential future paths. 2. The mechanics of debt weaponization. Fractional reserve banking. Fractional reserve banking allows banks to lend out multiples of their deposits, creating a banking multiplier effect of at least 10 to 1. For every $10 deposited, banks can lend $9, leaving only $1 in reserve. This creates a highly leveraged system where multiple entities have a claim on the same deposit. In the event of a bank run, reserves are insufficient to satisfy all claimants, underscoring the system's fragility. Tailored debt products. Banks have developed a range of debt products designed to target every economic actor. Credit card debt. Unsecured loans with annual percentage rates, APRs, ranging from 15 to 30%, creating a cycle of dependency for consumers. Sovereign debt. Loans to governments, often leaving emerging economies indebted for decades. Countries receiving IMF or World Bank assistance frequently owe more than they originally borrowed. Mortgage debt. Long-term loans that tie households to 20 to 30 years of repayment, locking up savings and making capital gains on property difficult to realize due to taxes, refinancing costs, and relocation fees. The banking multiplier. This system amplifies leverage by allowing banks to continually issue credit, ensuring that debt grows faster than the underlying economy. The result is a structural dependency on refinancing and perpetual debt servicing. 3. The insidious role of correspondent banking. Correspondent banking fragments the global financial system into geographic jurisdictions, requiring additional credit layers and borrowing to facilitate cross-border transactions. Each jurisdiction must maintain liquidity pools to ensure transactional flow, adding complexity and cost. This system imposes hidden fees on international trade and commerce, effectively taxing simple transactions as they cross borders. By perpetuating inefficiencies, correspondent banking enriches financial institutions while hindering global economic productivity. 4. The systemic fragility of leverage. Understanding leverage. Leverage amplifies the potential for returns, but also increases systemic risk. In certain financial contexts, leverage ratios can range between 50 to 100x the value of underlying collateral, as seen in Forex markets, trading platforms offering 50 to 100x leverage on currencies. Derivatives markets, instruments like swaps and futures with high leverage due to minimal collateral requirements. Shadow banking, unregulated entities operating with significantly higher leverage than traditional banks. Adjusted figures. In more regulated environments, leverage ratios are typically lower, such as 10 to 20x for traditional banks and 25 to 50x for hedge funds. However, even these figures reveal the inherent risks in financial markets. The 2008 financial crisis serves as a stark reminder of how excessive leverage can lead to systemic collapse. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. 5. Socioeconomic consequences. The reliance on debt and leverage has far-reaching consequences, including inflation. Quantitative easing, QE, expands central bank balance sheets, injecting liquidity but devaluing currencies and driving up prices. Income inequality. Wealth gaps widen as asset owners benefit disproportionately from QE, while wage earners face stagnant incomes. Civil unrest. Economic disparities lead to social tensions, exacerbating political instability. Exclusion. Rising costs of essential utilities, such as housing and healthcare, price out lower-income populations. 6. DeFi as a disruptive alternative. Decentralized finance, DeFi, challenges the traditional financial system by removing geographic and regulatory barriers, enabling access for the unbanked and underbanked, eliminating intermediaries, reducing transaction costs, and promoting transparency. Offering a global, permissionless financial infrastructure that democratizes access to capital. Examples include blockchain-based lending, decentralized exchanges, and tokenized assets, all of which provide viable alternatives to traditional banking. Number 7. Potential solutions. Sound money policies. Gold or Bitcoin-backed systems constrain money issuance, reducing inflation and promoting stability. Debt jubilee or restructuring. Periodic forgiveness of unsustainable debts can reset the financial system and reduce inequality. Regulatory reform. Stricter limits on leverage and increased transparency in derivatives and shadow banking can mitigate systemic risks. Equity-backed and asset-backed finance. Sharia finance offers a model with less leverage, where loans are directly tied to tangible assets. This ensures a clear link between credit and the underlying collateral, reducing systemic fragility. Number 8. The tough choice. Correction or bailout? When faced with systemic crises, policymakers must choose between allowing the financial system to correct through defaults and deleveraging, which causes short-term pain but restores equilibrium, bailing out the economy via QE, which postpones collapse but exacerbates long-term issues such as inflation, inequality, and systemic fragility. This trade-off defines the current era of financial decision-making. 9. Conclusion. The weaponization of debt perpetuates wealth transfer and systemic instability, creating a fragile and unequal global economy. However, decentralized finance and alternative models offer hope for a more equitable and sustainable financial future. By addressing the root causes of systemic fragility and embracing innovation, we can begin to dismantle the mechanisms that have entrenched dependency and inequality in the financial system.